In just 1 week, the Fed printed $300 billion. The total amount of liquidity to be injected into the markets is estimated at $4 trillion. Bitcoin is already at 27,000, and on such behavior of the regulator, everyone expects the growth to continue. Is the new bull market finally here? Or another trap? Let's get to the bottom of this. You may have noticed that yesterday I was talking about the financial crisis, and today I'm talking about a bull market. I don't reject yesterday's video, and the situation it describes is still relevant if the conditions are fulfilled, namely the continuing collapse of the US and European banking systems, which will lead to a huge debt crisis. What we are talking about today is the Fed trying to prevent such a scenario. The only question is, will it succeed? Let's look at these two charts. Since last March, the Fed has been conducting quantitative tightening, which is when the regulator sells off its own balance sheet assets and thereby takes away market liquidity. All of it in that time, they have managed to reduce their balance sheet by just over $600 billion, and now chart number 2. In just 1 week, the Fed's balance sheet has grown by $300 billion, which means it only took them 7 days to cross out half of the work they've been doing all year. What a lot of money that is. $164 billion was allocated from the Fed's 2 reserve funds. $152 billion went through what's called the discount window. Basically, it's such a tool for banks to get liquidity quickly from the Fed. The previous record, the use of this discount window, was set in 2008 year, during the financial crisis, and was $111 billion. In general, the money flowed into the market, and it works as part of the Fed's bank support program announced on Sunday, where they promised to give as much as it would take to return funds to all depositors of troubled banks. Twitter is already celebrating the victory over the bear market. This chart shows how urgent the liquidity fill to the banks was, compared to the crisis of 2008 and 2020. The particularly COVID 2020 year was telling in terms of how the printing press can solve any problem, even if the economy is stopped physically by quarantining businesses. Hence, the conclusion is that the Fed will no longer raise rates. On the contrary, they will go down to allow banks to borrow even more money and thus solve all the problems. An article by the former head of BitMEX crypto exchange Arthur Hayes was released. Recall that he became the former head of the exchange after he was put on trial and is now serving his sentence while under house arrest for violation of anti-money laundering rules. But he managed to get away from accusations of price manipulation on the crypto market. Now Arthur has a lot of time and often brings us his analytics. He took a look at the situation since 1920, when the Federal Reserve abruptly zeroed out the rate and kept it at this level for a very long time. During this time, banks accumulated a lot of bonds in their portfolios, which fell in price after the rate increase began. And today, American banks have unrealized losses in the amount of $620 billion. Further, the situation developed in such a way that banks, having a big suitcase without a handle in the form of fallen-in-price bonds, could not raise the rates on deposits as the Fed rate was growing, but those pennies were not enough for people, and they started taking money from banks and investing them into bonds on their own, because new issues of bonds gave higher yield than deposits. To return money to depositors, banks had to sell bonds at a loss, which put them on the edge of bankruptcy. As a result, the Fed had to urgently clean up and give them money. This problem wouldn't have happened if the outflows from deposits hadn't been so great, and the banks could have held on to their bonds until maturity, or just thought of it in time and moved to other assets. But now we have what we have. Arthur goes on to discuss how global the current problem is. He thinks the Fed would need as much as $4.4 trillion to fix it as it did 3 years ago. He expects the Bank Savers bailout program to be extended next year, and the global financial system will be completely overhauled as a result. Moreover, to somehow cope with the flow of cheap liquidity, he does not rule out allowing the launch of a spot ETF fund for bitcoins, which will further trap the rise in the price of the first cryptocurrency. It's just a great plan for those who aren't afraid of huge inflation and bet on Bitcoin. Only at the next meeting, 5 days from now, the Fed will continue to raise rates. Why they will do this, I will tell you right now, and you subscribe to Telegram, the link right below the video. Why does everyone expect the Fed to now lower the rate? The number one reason is because that is what they did in the last crises. You can see it for yourself on this chart. Pay attention to the 2000th, 2008th, and 2020th years. The second reason is that the Fed is not giving money to the banks for free, but at an interest rate that is also tied to the rate, meaning that to save the banks, the Fed needs to lower the rate, and then they can hand out cheap money, because current loans for banks, which are already sitting with huge paper losses, might be an impossible burden to bear. Except we have a tool that is almost never wrong, and according to it, at the March 22nd meeting, the Fed will, against logic, raise the rate another 25 points with an 80% probability. Why would they do that? For the same reason why yesterday the European Central Bank raised the rate by 50 points, although the European banks have similar problems and they need help urgently. The regulators are behaving that way because they are afraid of causing panic in the markets. A sharp reversal in monetary policy is a signal of a new financial crisis, and investors are well aware of that. That is why yesterday the ECB did what it had planned before the banks collapsed, to show that they are in control. For the same reason, the Fed should continue to hold its line at the March 22nd meeting and raise rates, and Jerome Powell will be telling the press that they are fighting inflation and that the banking system is fine. Maybe we are in a unique situation. If the Fed decides to cut the rate at the meeting, the markets will take it as a sell signal because everyone is afraid of the crisis. And it goes according to the scheme when everything collapses first, and only then the Fed's printing press starts pushing up the prices of various assets. Please support this video with a teaser. Better yet, subscribe if you like it. Thanks for watching. Your cryptocurrency.